So it's just, it's not good. It's not bad. It's just what it is. It's just the game that we're playing. And like I've said, and Albert, you've said this plenty of times, no matter what is happening in the market, or in this case, what is not happening in the market, we're close to 7% interest. We're at close to 6.7% interest on average. Somebody's going to make a lot of money today. And somebody's going
Yeah.
to buy a deal today that will forever change the legacy of their empire. And that's going to happen today, no matter what the deal is, no matter what it is, right? Welcome to REI 101.
Are we streaming live, Austin?
We are live on Facebook, I think.
Oh.
We should be. You never know if it's actually working or not, but we got some deals. We're going to be taking a look at today. Live deal flow. We are talking about multifamily. Multifamily properties. Albert, how are you doing, brother?
I'm doing well, man. It's Monday, new month, new week. Um, are you ready to really get baked in this Texas heat in August? That's when it gets hot, man.
I am, dude. I ran like 8.5 miles yesterday, and I didn't start until like 8 o'clock in the morning. So it was hot. I finished around 10 o'clock, and it was a rough
That's
one.
too late for me. I went and ran 3 miles this morning. I think I started maybe about 7:30-ish, 7:40.
Yeah,
And when I got back to the house, I just 3 miles, I was drenched.
I know. It was. I don't know if I were to run a long race in this type of heat, I would probably have to change my clothes like 5 times.
Oh, definitely have to change your shoes because your socks and shoes just get just soaked, and
Yeah.
then you get blisters and all that stuff. But
No,
it's
no
never,
blisters for me. That is not something that I am interested
no,
in getting
no.
blisters. But you know what? I'm interested in making wise investments, and whether that be an investment in my running shoes, my running socks, or any type of running gear or real estate. I want that to be a good investment, right? So we're going to be talking about some multifamily deals. I want to share some data with you, um, because we are still in this market, right? That is, everybody's asking like, what the heck is going on with this crazy real estate market? Well, the answer is really nothing is going on. I'm going to pull up some market data that we ran. That's the whole problem, that nothing is happening.
Right. So
Um,
like nothing selling, no offers, no.
no, not at all.
You don't even
Can you
have
see
people
my
lowballing offers.
yeah, well, they say the offers are low ball offers, but are if all the offers are the same, is it really a low ball offer, or is the seller just high on their list price? Something to think about. So we're in the beginning of August, so let's hit some data. So days on market, July is typically pretty hot. June, July. And why do you think that is? Why do you think houses sell faster in the summer generally? If you look at this kind of heat.
Oh, because people are typically trying to find where they're going to live before they send their kids to school.
Yeah.
They want to get all that stuff done before summer's over. Especially people that are moving to new school districts or people that are coming from out of town or out of state. They've been doing their research, and they want to put those offers in and close those transactions before, mid-August,
Yeah.
right? Preferably June, July. And then that gives them a little time to prepare to get their kids into school. I mean,
That's
that's kind
100%. School is a very motivating factor. 5 years ago in July, it took 23 days to sell a house. Right now, we're
of,
sitting at 50. 50
Wow.
days to sell
Yeah.
a house. Here's a fun one. This is one that I recommend everybody look at is the average original list price. So in June, houses were being listed for 479. They were selling for 450.
Hmm.
So this number is actually improving. It's
Yeah.
almost as if
Hmm.
people are starting to accept the market that we're in. Because you go back to May, they were listing these houses at 492 and they were selling at 442. It's like when you list high, they sell low. When you list a little bit lower, they sell a little bit higher. When you list way high, like close to 500 right here, you
Yeah.
see March and April, they were listed for
Hmm.
500. They sold for 15% less than what they were
Wow.
listed for. This is a very, 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 very big deal. There's a very important principle behind this. And I've been saying this since the beginning. If you list high, you're going to lose money if you list it too high. This is where it pays to be knowledgeable about the market, or at least have an agent that's knowledgeable about the market. And this is what happens. This is the proof when you overprice a house. So, homes that sold in the first month in July, this is 0 to 30 days on market, they sold for an average of $468,000. Once it went past day 30, it dropped to 420,000. That's a difference of $46,000. Now they eventually come up. Patience does pay off, you know, if you sit on the market for 6 or 12 months,
Sure.
but you just never have that opportunity to go back to the way things were. So that's an important thing too. So for investors, if you're flipping a house, if you have a house going to market and you need to sell the house, price it right.
Price it right.
And if there's anybody out there telling you why they think that your house is priced too high, don't automatically get in defensive mode about that. No matter how bad you don't want to hear why your listing is too high, don't get defensive about it because the truth, my friend, will set you free. And it's better to lose a little bit of money than a lot of money, but it's better to make a little bit of money than to lose money.
Yes.
So this is a that number's not right, but 5.2 months of inventory. And then we got new listings, 12,000 new listings hit the market in July for a total of 52,000 listings.
Wow.
We had less than 40 listings in March. Now we're over 50. And out of those 52,000, less than 10% of those listings sold, 4,770, only 9%. So this may get updated in the next few days. Hopefully it does, but you know, on average, it's like 20%, 15%, 13% of
Yeah.
inventory selling. That's not a seller's market that we're in. It's a buyer's market, which means it's time to buy. That's why we're going to be talking about some data. We're going to be talking about some deals today. And then we're talking
Yeah.
about new construction. July, we still need to update this number on July, but we're still looking at, we think it's closer to half of all listings are new construction. It's more than 30. A lot of the new construction selling is not on the MLS. So yeah, that's it. What do you think about that, man? That's pretty wild, huh?
Just nothing's happening, man. Nothing's moving. Yeah, I've heard the same thing. So
Nothing's nothing's moving.
seeing the numbers is just wow. That data.
Yeah, and so it's just it's not good, it's not bad. It's just what it is. It's just the game that we're playing. And like I've said, and Albert, you've said this plenty of times, no matter what is happening in the market, or in this case, what is not happening in the market, we're close to 7% interest. We're at close to 6.7% interest on average. Somebody's going to make a lot of money today. And somebody's
Yeah.
going to buy a deal today that will forever change the legacy of their empire. And that's going to happen today, no matter what the deal is, no matter what it is, right? So We got some deals we want to talk about. We're gonna bring up a deal. So, what do we want to call this one?
123 Main Street.
Okay, we're gonna look at 123 Main Street
Yes.
today, and this is a. Tell me a little bit about 123 Main Street because this deal is so good that we can't tell anybody what it actually is. So,
Yeah, so this came to me. Honestly, I don't know if it's a wholesaler or broker or what, but because they're talking about the seller wanting to meet us when we go look at this property. So we'll figure that out. But it's a 9 unit multifamily.
mhm.
It is a 6 unit like apartment, and there's a duplex, and then there's a single family home.
Yeah,
So the duplex, I think, is kind of like a up-down duplex, if I'm not mistaken. The single
uh-huh,
family home is kind of up front, and then the six apartments, and it's all on one lot, and they're all about 600, 750 square feet, so pretty small, right?
hmm.
And the description said they're all two ones, so those are really small two ones, but they've all been fully remodeled already. So that's the other thing that I'm not used to, right? Is coming into properties that are already remodeled because I don't really like to buy things at retail. Um, they've all got their own HVACs per unit.
Hmm.
They all are individually metered, which is great. Um, and seven of them are occupied and only two are vacant. So that's also good.
So
So
nine.
that's
So that's a little less than 80%.
yeah. So a little bit more on the description. There's 12 parking spaces. There's a laundry facility with two washers, two dryers that are coin operated. That's a question we need to ask on Wednesday is who owns those,
Yeah.
right? Does that belong to the property or are those leased out or something like that? And that could also, knowing that Austin, we want to take a look at the service on those if it's owned
Hmm.
by the property, right?
In
Let me
my
see.
experience with multifamily, and if anybody has a different experience, I'd love to hear. The amenities like laundry typically don't contribute significantly to the income,
Mhm.
but it's just a nice thing to have. Like
Yeah,
people just like living there because there's laundry there, the
exactly.
laundromat.
So it makes it a little bit more desirable, right? Maybe you can command a little bit higher rent as opposed to like an apartment complex that doesn't
Hmm.
have on-site, washing services or laundry services. So we can kind of go through some of the numbers now. Do you have any other questions about the description of the property?
No, I think that I'm going to share my screen.
Yeah, let
No,
me
I
bring
think
up
that's it.
your awesome calculator too. Go for it.
This is market data that we're seeing right now
Okay.
in the Houston area. So that 12.3% is kind of a target where you want to get
Oh,
for
okay.
vacancy. So
Gotcha.
that's all in the market. These cap rates are low. And they're going to include, like in CoStar, for instance, this includes like your luxury A class all the way down to your C minus. But would you say that this is probably like a C class, C plus?
I would say this is probably a C plus. Um, what's interesting about this particular area, when I'm looking at rents around the area for 2-1 apartments, so two bedrooms, single bath apartments,
Hmm.
the lowest range, like the 25th percentile, is $985.
Okay.
The,
So
the
900.
highest range, the highest range, 75th percentile, is $2,000. All right. So now that's kind of on the other side of a major road, right? That $2,000, and those might be newer apartments.
Yeah.
But we're looking at averages really between like 1,000 and about $1,500. So
Okay.
there may be some opportunities here to, increase these rents slightly in the future.
So that's kind of like what CoStar does a star rating, 5 stars. So
Hmm.
your 2 star and your 1 star, you're probably That's probably about it. These cap rates are going to typically be higher on
Yeah.
those on like C class properties. Vacancy
Hmm.
rates, it's about the same. It's about the same, but market asking rate about $1,000. So do you believe that it's possible to get those rents up closer to $1,000?
So right now, the 6 units apartments, they're all renting for $1,000 right now. I think we might be able to get those up to 1,100, you know, maybe even 1,150, 1,200.
Okay.
All right, because there's some 848 square foot apartments, two ones that are renting for 1,200 bucks, you know.
Okay.
So on the same street, Austin. So could be something interesting to think about, right? But let's go through some of the numbers here. All
Okay.
right.
So what do we know? Do we have income and expenses or just income?
Yeah, we have income and some expenses too. So we can kind of look at both of these things. Let's look at income first, okay?
Okay. So what do you have for gross income?
So on the gross income, like per month right now is $7,100 times 12 is $85,200. That's the gross income.
That's your gross income is say that number again?
85,200.
85,200. Okay, so
Yep.
that's before expenses. And what do you have on expenses?
So on expenses, I've got taxes at 12,500. I've got insurance at 5,500. I've got maintenance costs 1,500 annually. Yeah. I think that's it right now. Let's see where's that take us?
Okay, so
Yeah,
65,000.
65, 700. Yeah, that's what in their description, that's what they're saying the NOI is about 65, 700.
And a good way to stress test this. What was that gross income again? 85.
85, 200.
Now, if you ever have a situation where you don't know the expenses, um, the in the market, 40% is probably reasonable. You could probably do better than that. You could probably do closer to 30, depending on whether or not you're managing it yourself. But that's going to give me 51,000. So it may be a little bit less than that. This case, we're going to manage it ourselves, right? So we're not hiring a property manager.
Well, we'll have a property management fee that would go into this though.
Right.
Yeah.
So you may want to be somewhere between, you said 85,200, right? For the gross
All right.
income. So you
Yeah.
may want to, like, for your pro forma, you want to maybe a little bit higher just because of that reason for that property management fee on there. Let's say we're at 57,500. Would you agree that's reasonable?
So what was the number of that before? Yes, yes, that's reasonable if you factor in property management. Yep.
Okay. So 40%, somewhere between 35 to 40% is probably a good rule of thumb going into this. With underwriting, your bankers, your lenders are typically going to want to see you put that in there. The property management typically is going to be somewhere between 8% to 10% on a multifamily.
Yeah.
And then on single families, it may be like 10 to 12, a little bit higher on that.
Hmm.
So, do we have an asking price on this?
Yeah, asking price is 600,000.
600,000. So the first number that I get is this is a cap rate. Now, I'm in a market right now where cap rates are 7.2, which doesn't 7.2 does not give most of these deals an opportunity for cash to flow through their property. A 9.58 cap rate certainly does. And if you don't know what a cap rate, the easiest way to understand cap rate is if you bought the property without financing, this would be the return on your investment. This is without financing. So this is
Hmm.
just cash flow before financing. That's your cap rate right there. Now, this is where the power of financing comes into play because this will be financed. Now, What do we know about the financing options here? Is this a deal where the seller can finance it?
Yes, I mean that we don't know the terms 100%, but they are willing to discuss seller financing option. They're asking for a down payment of 125. We may be able to get them down to 120 on the
Okay.
down payment, which is, would be 20%. And we can kind of just take a guess on the interest rate, anything more than current rates, I think would be a good start. So probably 7% might be a good start.
Okay. Let's see what we
Yeah.
got to do to make this work at 7%. So in residential, with single family homes, your amortization typically will be 30 on commercial lending, DSCR loans. You're typically going to see 20 to 25. We're going to try to make this happen at 25, but we'll break down what's going on. So in when you bring this financing in at 7%,
Hmm.
your investment is not 600,000.
Right.
It's 120. So your down payment is your investment.
Hmm.
So every month you have a mortgage payment, and your annual debt service is going to cost you about 40,710. So if your net profit is 57,000, so that's what we're estimating. If our net profit is 57,000,
Hmm.
and then we pay our mortgages of 40,000,
Hmm.
we're getting a cash flow of about 16,000 a year.
When we looked at the amortization, does that make a difference if it's like 25? What if it's amortized over 30 years? Does that matter?
Yeah, it's going to change. So if you keep an eye on this annual cash flow right here,
Yeah.
it's
Yeah.
16,000, which is this is where we get cash on cash return. So the cash on cash return is based on your investment, which is your down
Hmm.
payment.
Hmm.
After you make a net profit and you pay your mortgage, this is what's left over. That's a 14% cash on cash return. If we change that amortization to a 30 year, it goes from 14 to 16. That adds 2 points to it.
Hmm.
So this still looks good and it meets this 1.25 target DSCR. So just to recap on DSCR, what is DSCR? This is basically saying for every dollar, it's a ratio, right? For every dollar that
Right.
you're paying on your mortgage, you have 50 cents left over. So your
And this,
net is 150% of what your mortgage is.
right. And this is with the two empty units, right? And you and I, when we were talking about this last week, you made a good statement. You said, well, as soon as we run out those two, one's going to come empty, pretty much. So we're almost always probably going to have one vacant. Are you
Yeah.
thinking that we'll always have two vacant?
No, when you're at that 12% vacancy, that's
Yeah.
about one divided by nine is 0.11. That's 11%.
Yeah.
So one consistent vacancy out of 9 units, that's market.
So
That's
like
market
what,
perf
so okay, so let's say we rent it out, because what's not rented out is a duplex in the back. Um, and those I think are smaller.
Mhm.
So let's say those rent out for 900. All right. Let's say we just rent out one of those for 900. So that's 8,000 uh times 12. That's 96,000 on the gross.
Mhm.
All right. So 96,000 minus, let's see, where were we? Minus 1,500, minus 12,500, minus 5,500. So that puts us at 76,500 on the NOI. But then we're gonna put property management at 8%. So 76,500. So that puts us our it puts our NOI after property management at 70,380. If we can rent out one more apartment.
So that's a pretty nice deal. And I took
Yeah.
the amortization back to
Yeah.
25%.
So we can rent out one more apartment at 900 bucks and keep eight rented,
Right.
right? Or fluctuate between eight and nine, between having seven and eight apartments rented throughout the
Yeah.
year. This
You,
fluctuates between like a 16% deal and a 24% deal,
that's a
right?
massive difference right there.
Yeah. It is. It is. So, typically, like for me as a property manager with this many units, if it's a single unit, we're charging 10%. I'm managing two duplexes for somebody, and we're at 8%.
Yeah.
So I think 8% is fair. You're going to have some initial startup expenses, right? Getting the place cleaned up, getting software implemented. The turnovers, right? The turnovers have expenses too, Austin. That again, this is kind of digging into the details, but I don't think we really put it into this formula. But something to keep in mind is, the property manager usually gets paid a fee for placing residents,
Yeah.
right? Whether it's a percentage or it's a flat fee, or if it's listed and an agent brings a tenant, right? Then, we're working on those fees, right? And all
Yeah.
that stuff can be negotiated. Okay.
Exactly.
So yeah, I think it is a pretty solid deal. Um, I honestly I can't wait. I'm gonna go take a look at it. I've got some guys working at my house today. When they're done, I'm just gonna go drive by there
Cool.
because you and I were both very kind of anxious about seeing this as soon as possible.
Yeah.
'Cause we were thinking, man, if these numbers are right, why hasn't somebody gotten this deal yet, right? Unless it's in just a really horrible part of town, okay, I'm gonna go drive by there this afternoon. The guys that I'm talking to set this up, they don't seem very urgent. I'm urgent. I'm just like, what day, blah, blah, blah. And they're like, hey, take your time. I was like, no, I don't want to take my time. I want to go take a look at this because if this is a good deal, I want to just lock this up now. Now, Austin, being a commercial agent broker, what kind of inspections do you do on something like this, on this type of property? Because I mean, we wouldn't call a residential inspector, would we? Or would we call?
Yeah, you could. You can certainly
Okay,
do that. The same inspectors that we're using
okay.
for houses can go in and inspect these properties. On something like this, you definitely want to get a contractor like Javier to go out there. I mean, experienced investors are going to be able to walk a property and pick up pretty quick what needs immediate attention. Um, Go ahead. Go ahead.
We're going to need to look at every unit, right? So we need access to every unit.
Yes.
Okay. And again, I don't know if this is from a wholesaler or not, but we need to have an inspection period because I don't feel comfortable on a
Yeah.
deal this size of giving non-refundable earnest money to anybody.
And you typically need, three times as much time,
So
so
like
instead of,
about 30, like a 30-day,
yeah,
inspection
21
period.
to 30 days because,
Yeah,
you know, sometimes you can't get in all the units at one time because you're
right,
you're coordinating with multiple tenants and
right.
um, you know, do you the question is what do you know about the foundation? If there's no information about the foundation, you may need a foundation inspection. If there's no You may need roof. HVAC needs to be inspected. And, in some cases, some investors will actually bring a team of contractors in, one to focus on the electrical, another focus on the HVAC, another one to do foundation. And it just makes a whole lot more sense practically from a practical perspective to do it all at one time.
Hmm.
Because multifamily is the only thing more complicated than inspecting a multifamily property is inspecting a self-storage property because you have to coordinate with all of the tenants. And usually, if you're nice and polite and act very professional, it's not that big of a deal. But there are some situations where um, the tenants are kind of they get scared or they get word of what's happening or you don't want you really don't want tenants to from an owner. If you're a seller, you certainly do not want your tenants to get scared about selling because
Right.
you can have all sorts of issues. And yeah, and so the seller's usually going to be pretty protective of their tenants. They're going to be very wary of buyers talking to the tenants. And
Mm.
that's one that you typically want to keep in mind to be very respectful of the seller because if you just start talking to tenants, most tenants will just start telling you things that the seller's not going to want you. And it may
Hmm.
not even be true. Some of the stuff that tenants will like you can't verify it. The tenants may say, well, there's mold in the building. Well, would you want your tenants telling your buyer that? That may or may not be true.
Mm-mm.
That's the buyer's job to investigate. That's what their due diligence is for.
Hmm.
Sometimes tenants will just say things like that just to run the because they think, oh, we're going to get a new owner. I'm on month to month. They're going to raise my rents.
Hmm.
So you get a lot of that anyway. So um, let's look at the interest rate too, because
Okay.
uh, we forget how big of a factor the interest rate is. So if you're looking right here, 7% interest rate, your your annual debt service goes from 40, and look what it happens if I go from 7 to 6.5. It's going to go from 40,000 down to 38,000. That's another point and a quarter on my return. If I can get this down to 6%, it's going to go down. That's $3,000 a year that we're saving just by getting a point down
So,
on the interest rate.
right. So that's the annual debt service, right? So that's principal and interest that the owner would be receiving.
Hmm.
So 37,000, right? So, you know, I've talked to people who have properties like single family properties, all right, and they're offering seller finance options. Every person I've talked to that offers seller finance options, they want more than what the bank is charging, right? Actually, the only person that was willing to do less was a deal that I was working on myself for myself. Like
Hmm.
they were willing to do like 5%, which I thought was amazing, right? But I've talked to other investors who have properties that they're seller financing to people, or they're willing to seller finance to people, and I'll ask them, hey, what rate would you charge them? And they're like, oh, 9%, 10%. I'm like, wow, you know. So in your experience working with commercial properties, whether it's small multifamilies or whatever, do you have experience with seller finance options that are being offered? Are they typically above what the market interest rate is, or sometimes are they lower?
Not necessarily.
Not
So
necessarily what?
it's not necessarily higher than market
Okay.
anymore. Here's the reason. In 5 years ago, it would have been absolutely 100% because when interest rates were at 3%, 4% on a single family house, the only reason that a buyer would need the seller to finance is because the buyer posed a greater risk to the bank.
Mm-hmm.
In this situation, these types of situations now with these multifamilies, it's not necessarily the case because the bank's interest rates are high. And
Right.
now the person that's carrying more risk right now is the seller. Because a lot of these sellers, they're needing to get out the property and the bank is lending based on the performance of the asset. That's
Mm-hmm.
the kicker right there. The banks are lending based on the performance of the asset. If the asset's underperforming, then in a lot of cases, the seller has no choice but to finance it for 2 years if they want a chance at selling it. And
Yeah.
so when the buyer knows that the seller has limited options in regards to selling and financing options, the ball's in the buyer's court. And that's where we are right now. I think what you're I think what you're saying, like I think that trend flows with the market, and now that we're certainly in a buyer's market, then it is possible. It is a lot easier right now in this market to either A, get interest rates below market because the asset won't pass the test, or do this right here. So let's say that we do this for 8%. We still got
Mm-hmm.
a 21% cash on cash return. It still works.
Mm-hmm. Yeah.
A lot of sellers right now for properties that have like deferred maintenance, or in this case, even though there's 7 out of 9 tenants, it's still underperforming because it's not
Mm-hmm.
at that 88% vacancy.
Mm-hmm.
Sometimes these sellers will give you an interest only loan, and that gives the buyer a lot of flexibility for a year or two to get the property. Now you're not paying anything toward the equity, you're paying interest only, but you're cash flowing quite a bit. And so going from interest only takes gives you another $5,000, $6,000
Yeah. Yeah.
a year to work with.
Yeah,
Eh,
so I'm just kind of thinking like the game plan, right? Is because 20% down is a sizable amount, right?
mhm.
That's not like what an unqualified buyer would bring, right?
Right.
Someone who's not qualified, who can't get a bank loan, right? I mean, we could go get a bank loan, but I'm just saying someone who cannot get a bank loan, typically they're not going to bring 20% down. So then they would be riskier, right, to
Yeah.
that seller as a seller
Hmm.
finance option. But someone like us, we're bringing 20% down. We would be seen as, hey, okay, you guys are qualified, right? Do you want to close this deal faster? Do you want it to take longer? Do you want mailbox money and not ever have to worry about, tenant issues and things like that or maintenance? Right? This is pure mailbox money. I would approach at something below market interest, the interest rate. That
Hmm.
would be like my first offer. It's like, hey, we've got 20% down. We're ready to get this under contract, go through the inspections. Let's talk about terms for the seller finance, and then I would start lower.
Yeah. So like we haven't even talked about negotiating the price, but
Right.
like 600,000 at 7% interest, that's a cash flow of 36,000. Let me take the interest only off. That's a cash flow of 29,000.
Right.
But if I go to 8% and I go like 550 as opposed to 600. So at 600 and 8%, my cash flow is 15,000. 550, my cash flow is like $25,000 more. 575, my cash flow is 18,000. So what I'm saying is that this interest rate, sometimes sellers are just happy just to get their purchase price, but it's really the interest rate. If I go from 8 to 7, it goes from 15 to 29.
Yeah.
I mean, it goes from 25
So I,
to
I, I mean, I'm
29.
fine with the purchase price, but I'm thinking, can we get this down to six?
Yeah, you get it down to 6. Like, so they're going to ask for 8, your cash flow is going to be 25. We get it down to 6. That gives you another
Yeah.
$8,000 a
Yeah.
year. That's a big difference.
Yeah.
$8,000 a year on a $120,000
Yes.
investment.
That's almost a 30% return, right? That's almost getting your money back in 3 years,
That's a
right?
massive return. And then you can fill this out on the amortization calculator. So it may be a 25-year amortization. Principal and interest is going to be about 3,400 a month, but they're going to want that balloon payment year
Let's say
five.
5 years, yeah.
Yeah, probably 5 years is what you want to look at.
So what would the okay, so the loan, okay, 437 is where we would be in 5 years. So we'd have to
Hmm.
go get 437 financed in 5 years.
Yeah, you'd have to refinance it, and if market rates come down, easy. And if the market rates don't come down, then first thing you would try to do is just renegotiate with.
Well, it's not awful because we've paid almost 40, well, we've paid $40,000 off the loan,
Yeah,
So if interest rates are a little bit higher, by a percentage point or something, right? Hopefully they're not like 9 or 10%.
and in
But
five
if
years, this is going to be worth
Yeah,
$700,000.
that's what I'm saying, right?
Yeah,
So
you could sell it.
Yeah, you can
yeah, we
certainly
could
sell
sell
it.
it.
Yeah, you can absolutely sell it. But that's your payoff in
Yeah.
5 years. So I think uh, these are the kind of deals that you kind of really got to move on right now in this market right now because
Yeah.
nobody else is really buying them. And it's interesting. You're describing pretty low seller motivation.
Yeah. It's just I don't, everything's been via text. I have talked to the person online. I'm sorry, on the phone. But they just don't seem very like, now. You know what I mean? Like, because we were gonna look at it last week, and they wanted to reschedule for Wednesday of this week,
Hmm.
and so I was like, okay, which is what we're doing. So
Well, you never know. Could be talking to the wrong person. Who knows? Are you?
that's the other, yeah. So we could, I don't know. This is fun anyway. This is fun, like going through the process.
I want to see if I can show you one more thing. This is a new thing I've been working on. Um, that if I haven't tested this yet, so this is going to be the first time. But the thing that just makes so much money is really not the cash flow. It's the appreciation. And so this is an IRR calculator that
Yeah,
I'm
let's look at
working on.
that. Yeah.
So this is a $600,000 purchase price. Um, what I got to do is it's actually going to be 480, right? It's going to be your.
Yeah. Well,
So I need to add what the down payment is going to be. So cash flow, what did we say the cash flow is going to be?
like 70,000.
Yep. So let's say 70,000. And let's say it stays the same. Year one, you're going to cash flow 70,000. Year two, you're going to cash flow 70,000. And we know that this number is going to go up.
Yeah.
The cash flow, but worst case scenario, it doesn't go up. Purchase price 700,000. But when we sell it, we're going to sell it for put 600 here just for easy math so I can show you. And I'll continue working on this, but this is without financing. Say you bought this without financing at 600,000, then you sell it in 5 years at 700,000
Hmm.
with like a 6% closing cost. There's a negative return right there. So that's what happens when you buy without the leverage. I'm trying to
Mm.
see how it got that. I'll have to play with this some more.
Okay.
I'll work on this week and then show you.
Okay.
But the thing that I think is important to see is that when you do leverage that investment, you're only investing 120,000 to a property, but every year one, it's going to appreciate by 5%. So that 600,000 is going to appreciate by $30,000 just in the first year. So even on the first year alone, that $30,000 realization at a $120,000 investment, that's a 25% return just on the appreciation right
Yeah.
there. Um, so that IRR is going to be like in the 30s or 40s when it's all said and done. So that's it for now. We got a lot more deals like that. If you have a specific deal you want us to run, you can just make up a deal and send it to us. We'll be happy to look at it.
Yeah.
But it's real estate. It's great. Good opportunities right now. Any last words? Any final thoughts, brother?
No, man, I'm just gonna spend the afternoon kind of digging into the rental market over there just to take a look at some of the listings that have rented out, and kind of compare it to the photos that we've seen. I'm looking forward to meeting with you on Wednesday and checking this out, walking this property, and negotiating with the seller. So, because I think we're
Boom.
meeting with the seller, so that'd be great.
I'm looking forward to it too. And everybody, thanks for joining. Don't forget to like and subscribe. We're on YouTube, Spotify, Apple. We're all over the place. And thanks for the support. Have a great week. Happy August. Bye.
Bye.